Hello, Mark.
Hey, Kris,
It's,
how are you?
I'm good. It's good to have you on here. We're going to have some fun today. We're going to talk about the anatomy of a covered call, lessons from overwriting Tesla stock. I'm going to put the link out on Twitter for everybody. But if you want to just like mention, geez, what the origin of this little project was.
Yeah, I'm thinking back to the some of the early conversations we had about this, and the covered call, obviously most popular option strategy, the 101 strategy you can do in any margin account. Actually, you don't even need a margin account. I think you can do it in a cash account. So you see a lot of commentary about covered calls. We've talked about these covered call ETFs that are out there. There's a multi-billions, trading in all these funds with systematic overwrites, and I think you and I both know there's a little bit more that goes on under the hood with this strategy. That it's not quite so simple as owning some stock, getting some extra income out of it. That there's really a lot to peel back on, and the while the seed might have been thinking about some of those ETFs and like the strategy overall, I think we uncovered some pretty interesting elements that, frankly, some of them surprised me.
Yeah, I think I found it. Well, I don't want to lead with what the surprises were, but there was a lot of surprises in here, and this was a I don't know this was I think was a really fun project because uh, I'm sort of always harping on the idea that this idea of like selling calls for income has it's a bit misleading because some portion of that premium that you're selling, most of the premium that you're selling, is a compensation for volatility or is a representation of how much the stock is going to move around. And I think that uh, whenever one trades an option, they what you are doing ultimately is you're trading volatility and separating the results of the volatility from the directional result is the essence of trading an option and using an option in any way. So uh, I was just kind of excited to like do an attribution. We'll talk about that pretty soon. And then, sorry, I'm just putting the link out for everyone. Uh, okay. And then I think that the process of stepping through this is I think is just educational on many, many levels, not just from how the options market prices volatility, but down to what you are actually trading when you trade an option. I just think there's stuff in here for beginners. There's stuff in here for people that are more investors that have come to the options market from the lens of a covered call, and then there's stuff here for more advanced practitioners, um, up to advanced and even like intermediates that are trying to understand how to think about the pricing and hedging of an option more broadly. So I think there's something for everybody.
And I don't think we could have picked a better example for some of this because choosing Tesla as the underlying gave us a world of different scenarios. And every time we came back to it, there was another month of expiry that changed the zigged and zagged in a different direction. So I think choosing one of these highly volatile underlyings that appreciated a significant amount really just, emphasized all the different mechanics of this trade.
Totally. Should we probably should get started on this then?
Yeah, let's dig into what is a covered call first. I think let's get down to some basic definitions. Um, so super 101 covered call is a long equity position where an out of the money or in the money at the money option where a call is sold against that underlying position. And to your point about income, often the way that trade's framed is collecting premium to sell the stock at a given price in the future. So you typically, like I said, it's done in out of the money options. You sell something above the current strike. The kind of folklore or traditional wisdom about this trade is that you buy the stock, you make money because it goes up, and you sold it at a higher price, and you get paid to do that. It sounds like a win-win-win in all those scenarios. But like you hinted at, the premium that you collect there really is exchange for getting short the right tail of returns in the spectrum. That you're getting paid a premium because that underlying stock has a volatility expectation, and being short that cuts off your upside potential there. So a covered call might look like an underlying stock position with some extra premium income on that, but really you've got a much different position depending on where stock goes, and how the kind of underlying market changes. So I think an interesting element that we'll dig in a little bit more is how that covered call will change over time, what the Greeks of that position are, and if you're putting on a 1 month trade, a covered call that you sell 30 days out behaves a little differently with 30 days, 28 days to expiration than a covered call that's got 2 and 3 days to expiration to go. And that particularly exposes itself when we look at some of the P&L attribution stuff.
Yeah, I think one thing I'm noticing here, it says, and I think it's just good to re-emphasize this. A covered call, even though you're selling a call, the whole package is long delta, as you mentioned here, because you own the stock, and if you own a stock, that's the same as owning 100 deltas of something. And then usually when you sell a call, you're selling an out of the money call, which is maybe something like a 20 to 30 delta. We'll call it a 25 delta. So it has the entire position is still very long delta. And to the idea of one habit I like to do whenever I'm trying to get an intuition for options, just think about the extremes as a good way of developing an intuition for how an option behaves. And as you said with the covered call, I think the easiest way people can see that you're short vol is to understand that if your choice was to buy a call, or sorry, to buy the stock and sell a call versus just buying less stock, you can see that you're short vol in the first example, because if the stock were to double, you would have been better off to just own 75% as much stock than you would have been had you let all your stock get called away, say up 10% after the stock doubles. And likewise, if the stock were to go to zero, you would have preferred to have been long only 75% as much stock than rather than to ride the whole 100% of the stock to zero and only collect a small amount of premium to offset that. So I think that that's the easiest way for me to understand that the position is short vols, to basically look at the extreme, double it or let it go to zero, and you can see very clearly that you are short vol. But let's talk about more about dynamically how to think about covered calls, which I think you're going to go to right now.
Yeah, so one trade, of course, you buy the stock, you sell the call. That's you can chart that on your classic P&L diagram of long equity, short call, and how that looks. But there isn't just one shot. Investing is a long-term event or a long-term process, and so how you manage that strategy over time, what expirations you're selecting, what strikes you're selecting. There's a lot of I guess both art and science really to executing that and implementing that strategy. And so, I think that's one of the catches. We talk about income, or even worse, using yield to describe that strategy. The idea of extrapolating a premium as something, because it's done over time, gets into some of the pitfalls of framing this as an investment strategy. But typically, I'd say the two big questions or two big choices you have when you're looking to execute this over time is, do you keep the stock or not keep the stock? And that's actually, if you're trading this over time, buying in the options is going to have a very different texture over time than if you were to say, let parts of your stock get called away and rebuy with smaller amounts. So some of those practical considerations of you as an investor with X shares in your account will really dictate different outcomes with this. It'll dictate different, return paths. It'll have different tax implications. So, even a simple buy stock, sell call strategy has a lot of different underlying nuances to, ways it can be carried forward.
Got it. So we can, Mark, can you tell us how, um, practically speaking, what did we do here? What did we demonstrate in our study?
So in this scenario, in our study, we made the assumption that you were buying back the option for a loss if it got, if it went in the money. And the effect of that is that you maintain a constant balance of shares, except for if stock splits, as Tesla did twice. But in theory, you keep your same balance of shares, and you're just accumulating generally short-term losses with that. That would obviously require additional funds. If you spend all your money on the stock and the call, those dynamics change. And that's why, often investors will choose to let some of it get called away and, perhaps rebuy in with smaller amounts down the line. But we chose to treat this as pure losses from the option landing in the money.
Okay. Remind me, what was the exact method that we used? So what did we do every month?
So we simulated a monthly covered call trade, kind of similar to like a lot of what these ETFs do. Or, honestly, I think that's kind of some of the standard wisdom about a trade, that trading out at 30 days, 25 to 30 delta or 20 to 30 delta, like you said, I'd say that's generally the sweet spot that I see investors tend to pick for covered calls. And there are a lot of good reasons for that. It represents the right amount of upside that they're willing to give away. It generally represents a premium that is palatable and seems like you're getting something there. So I think there are both, I guess, emotional reasons as well as more quantitative reasons why you might trade at that level. But every month we sold the 25 delta call on Tesla, not necessarily at 30 days, but just on the regular standard monthly expiration. So sometimes we're at 28-day cycles, sometimes it's a little bit longer. But we looked at every monthly expiration starting in 2018 and bought the stock at the beginning of January and sold calls every month for the next 7 years.
Wow. Okay. So and this is what's the last expiry that we go up to in this it was March, I believe, right?
Yes, we have through March in the main part of the study, but then bonus points for the April and May expirations that you added at the end there. Um, so over the course of that time, we can see Tesla moved quite a bit, and the if you want to go to the next slide here, I've got some more details on how a covered call is not stock ownership. Oops,
Oh, so this is maybe we'll.
I think it's the next one. Sorry,
Oh,
it
no
was out of
problem.
order.
Oh, sorry. There we go. Oh, sorry. Let me go. There we go.
There we go. So getting more into the actual results of demonstrating how a covered call is not necessarily stock ownership, and this is where that short vol comes in, is if you had simply bought Tesla at the beginning of 2018, you're up 12.4x on your money. The chart is parabolic with some drawdowns, some significant drawdowns. But the difference is if you had been overwriting throughout all that time, you gave away so much of that upside. And not only did you give that away because you were selling that 25 delta level, as we'll explore a little bit more, the path dependence in there means you're locking in losses at high levels and, letting the stock drop down again. That, depending on your method, like I was saying about letting shares get called away versus buying it in, that could have an impact there too. But at the end of the day, overwriting and buying that in only doubles your money over that period, which wouldn't even do as well as the S&P 500.
Right. So in other words, if you knew in advance that a stock was going to go up 1,000% over the next 6 years, it's probably a bad idea to overwrite calls on it.
It's probably a bad idea to overwrite calls on it. And, my knee jerk is going to say you should sell puts. You would probably get pretty wrecked selling puts, knowing the path of what happened in Tesla here. So maybe that's our next study. But when something's moving around this much, it's a dicey proposition to be short options.
Right. Yeah, this is I think that it's interesting because when I just think about index investing, um, if you I think if you look at the historical where returns come from historically, it's that most of the market's returns come from a few names over time. As a matter of fact, like most stocks eventually go bankrupt. So I always think of an index as it's just an algorithm which says I'm going to keep rebalancing into the winners and I'm going to cut my losers. I'm going to cut the companies that no longer deserve to be in the major index. And we're going to add new companies that do deserve to be in the index. And over time, index investing is sort of this rebalancing momentum idea. And a few companies in the economy drive most of the stock index returns. So this is inserting a personal thought, but it always struck me as a strange idea to say if I'm going to own individual equities, which have, in a sense, they have a positive skew, where unlike the indexes don't necessarily have a positive skew to them, but single names can. And if a couple of your names drive all the returns of the index, if I'm going to be investing in individual stocks, it always struck me as counterproductive to sell the right tail on something that I own because it has a right tail.
I think that's the perfect framing right there. That like knowing that distribution, and I think it's pretty extreme. I think it's like single digit percent of companies are contribute all of the positive returns over the last like 100 years. So exactly like you say, like if you're giving away the right tail in something that's designed to be equity upside, explosive, convect, all those benefits of putting all your money on the table, so to speak. It's not a debt instrument that like equity gets wiped first, so you want to get paid with that right tail. And giving it away for, I think we said the average monthly premium was something like 2% here, 2.25%.
Yeah. So what's interesting is like you would think, well, that's a good point. The monthly premium that you're selling every month, it will work out to somewhere around 2% of the stock price. If it were really free money, you would expect to make 24% a year on selling a 2% of premium every month. But as you see, you're not going to make 24% a year. So clearly these calls are not free money, which is like a very simple way to see that assertion is false. But we're going to go into the results more closely. I did want to mention this idea here of what we did with the in the study is we did a study of what happened if you wrote covered calls on Tesla, the 1 month covered calls, and then you bought the calls back at expiration every month rather than letting the stock get called away if it were to get called away. That's one strategy. So that's the sort of, we would call that the naive call selling strategy. A more advanced idea that we then explored later, and we'll get to that towards the end, is what was the performance of a delta hedged, selling that 25 delta call on a delta hedged basis. So not a covered call strategy at all, a delta neutral strategy where you are putting yourselves in the shoes of a vol trader and said, I'm going to sell this call, I'm going to delta hedge it, and every day I'm going to rebalance back to delta neutral and see how the performance of that is. And we end up doing that because that's where we want to learn about, it's an opportunity to learn about decomposing our P&L from what happened based on the direction. Obviously here, stock ownership, you made 12.37x your money over the last 7 years. Selling covered calls, you ended up making 2x your money. But what happened if you actually just delta hedged a position like you were a vol trader over the same period of time? We're going to explore that idea as well. But the to back up, we have our most basic version of this is the naive. We'll just call it the naive version. Not that people who do it are naive. We're just calling it the naive version, where you just say every month I'm just going to sell the 1 month call on an overwrite. But that wasn't the only thing we actually explored. I was going back to this slide here. Mark, I'll let you just kind of describe what you did here.
Yeah, perfect. And I think both of these are kind of questions you ask yourself and you say, okay, well, like I don't do anywhere near as well as just owning the stock. What's going wrong here? Where am I losing money in the options? Is it because vol is mispriced? Like that's where that hedge analysis comes in. Or maybe there's something you could do to be a little bit smarter about when you trade, right? The idea that you always want to systematically be overwriting this the same kind of delta out of the money option in the same size assumes that options are always overpriced, and that just can't always be the case. Regardless of the fact that there is a little bit of a persistent VRP premium, that the idea that every call or the same call is always a sale every month is a little, rote. And so we can say, what could we look at the market? What points of light are there that are out there that can help inform our trading? That is this a time to not sell? Is this a time to possibly sell more? We mostly looked at indicators as red light, green light type scenarios. So we used 3 different vol indicators because, of course, we're pricing volatility here. And we said, if I see indicators at these relative levels or absolute levels, a little bit breaking that down first. Relative levels we defined as the level of that indicator relative to some period of history. And so kind of the advantage of that compared to, like what percentile is it in over the last 30 days, year, whatever that is, compared to saying, is vol in Tesla above 50% annualized? Absolute levels kind of have some of that, backward looking. You've got the benefit of hindsight to say what is the right level there. So it's a little bit, more of a, call it, polluted information source because you have that benefit of hindsight. Whereas the relative is something that you could continue to, it adapts in the same way an index does, right? It adapts to what the dynamic is and says, are we at various different extremes? And so in the relative domain, we would generally say, is this indicator above the 50th and 75th percentile? We tested both of them. Are they in that percentile of the last X period? So the 3 indicators we used were the 30-day implied volatility. We used the 30-day volatility risk premium. And so the VRP, the volatility risk premium, is defined as what was the implied volatility 30 days ago? What did the option realize or the equity realize with the realized volatility over that period? And what's the difference between those two? So what did we think was going to happen 30 days ago compared to what did happen? Positive VRP indicates options are slightly, overpriced. A negative VRP would mean that the realized or historical vol was greater than what that option implied. So generally, you'd want to be selling options when VRPs are higher and positive. Of course, backward looking, but as a future looking indicator, we said high VRP, that's a time to sell. Same with high IV, that we looked for upper levels of that. Skew, we defined as the difference between the 25 delta put and the 25 delta call. So looking at those two, beginning of the wings options and figuring out the net difference between them. In these cases, we actually looked for traditionally skew. We would always measure put minus call. And so we actually want low examples of put skew, high examples of call skew. That we want the call side number to be higher as an indicator of when to sell. So when call skew was higher, calls were relatively higher priced to their puts. That was a positive signal to get into the trade. One more comment on indicators. There's a general rule of thumb I like to use is that generally I like to align indicators with the trade time frame. So looking back on a 30-day period is generally, it's of course interesting to contextualize multiple different intervals, but if you're trading at 30 days, it's useful to look at, in my opinion, the past 30 days and how that's been. So I think that's partly why we centered on those.
And to be clear on that, that means that if you are looking at the 30-day, if you're trying to decide whether we're going to sell the call, we're saying that if it's greater than the 50th percentile of IV of the last 30 days.
Yep.
Yep.
Exactly.
Got it.
And so we're looking at the IV of that call specifically, not necessarily the at the money IV. The 25 delta call IV.
Got it. Okay. So the time series that we're looking at to decide whether to sell is the past 30 days of the 25 delta call. And if the the idea is if the IV is in the top half of that measure, then that would be a positive signal that we would sell the call that month. If if on that day, and this is the day after, we sell the call every day on the day after expiry, correct? The next call.
Yep.
So if on that day it was greater than the 50th percentile, we get a signal that says go ahead and sell the call. If the call level was not above that percentile, we would not sell the call, and we would not check again until a month later, the day after the expiry. It's not as if we're checking every day.
That's exactly correct. There's
Okay.
one trade date that you scan the market and say, do all these check. If so, trade. If not, don't trade. Uh, and this just highlights all the implementation details that exist in a strategy like this. We think this is a simple strategy where you buy stock and sell a call every month. Like that's one sentence. But the reality is there are so many questions, like we said about buybacks. Whether are you trading on Monday, or do you roll that Friday afternoon? Do you wait exactly until 3:45, or do you trade? There's so many like little nitty gritty implementation details to a strategy that can have pretty significant impact on the end result. In our scenario, you're naked over the weekend, so if Tesla rips on a given weekend, like that's going to be unbounded returns. So there are some a lot of idiosyncrasies to even the simplest strategy.
That's such a good point. Like there's always some weird things going on that are, even when you don't make a choice, you've made a choice kind of thing. It's like you're in this, the way we've done this is one weekend a month. You have no option position because you wouldn't implement until the Monday after the expiry Friday. Another one, I didn't even think of it until now, but the idea that um, if we check every Monday after expiration and say, is the vol in the 50th greater than the 50th percentile to sell, then we would sell the call. I guess we should expect on average to trade 6 times a year. If expiration had no correlation at all with the vol level, which is, if it was random, which I don't think we even actually tested whether that was possibly true or not. But it only occurred to me now as you were describing this.
Oh, totally. It literally, as the more you talk about it, the more different iterations you can think of. And I mean, maybe there's a window where you say, if you don't trade on Monday, give me 2 or 3 days to still sell it. That maybe Tuesday you get a vol spike, and that would be a good opportunity. Um, and practically, that's how a lot of people trade. That practically, I think a lot of retail and professional traders alike are saying, I want to be in this position, but they're not on or off. If it's Monday, I'm taking the next month off. They're probably watching more, over the course of several days.
I think what's amusing. So I'll just say one last thing about the idea of indicators here, where it's, we started with a naive strategy and said, how did this go if we just blindly sold the 1 month call the Monday after every expiry? And then we start testing different indicators, like, well, what if the implied vol is high? Maybe that we should only sell when that's true. What if the VRP is high? Maybe we should only sell if that's true. What if the skew on the calls is expensive compared to its history? Maybe we only sell then. And you can kind of start to see how like an ETF issuer might start thinking, where they're starting to like mine for what is an idea that sort of worked that will show up nicely on a test, that could kind of sell assets. It's kind of as you kind of go through this exercise, it's a sense of like, I'm going to throw these things against the wall and see how they look. Um, but I think that's a bit instructive for somebody sitting at home to understand how somebody might start to design a strategy. by kind of throwing things against the wall. But I think the next slide talks about something, which is, I'll use Corey Hofstein's term, rebalance timing luck, because when it comes to options, when, like you said, if the vol spikes on Tuesday instead of Monday, you're one day off on whether you would have gotten a signal to sell or not. And regardless of how the strategy was constructed, your future results are just highly path dependent. And I'm going to click over to the next tab because you're going to talk about that here.
Highly path dependent. And it's like as I said in the very beginning, right? Like you couldn't have picked a more or a better example of a stock that has wild paths than Tesla, right? Like, and so by putting these options positions on, by putting on, I always say that's like the benefit and the curse of an options position is it's amazing that it's got an expiration. Like that's what gives it premium. That's what gives it like extrinsic value, because it's got potential in the defined period of time. But by defining that period, you are striking your outcome at that period and distinctly aligning yourself with price on that specific day. And it's even more than just like that specific day. It's that path dependency shows up in how your position evolves over time. So when you're looking at like your P&L on a daily basis, a big move early in an expiration cycle doesn't hurt as much as a big move later in an expiration cycle. And you'll get into some of this with some of the attribution here, but I have a simple example of June 2020. And 2020 was quite a year for Tesla. Now, 2025 also has been an interesting year for Tesla, but 2020 we had a number of good examples. And so this was before the first split that they did. Tesla, June 2020, we have Tesla already up 25% in the past 30 days. It's trading 1,000, and your 25 delta call is the 11:30 call. So June expiration, you sell that, or sorry, day after June expiration, you sell that July expiration, 11:30 call. You got 11.3% upside, and you collect $21 to do that trade.
Yeah, so you're selling, you again collect. There's that number again. You're collecting in this case 2.1% of option premium for 1 month.
Really nice that this example is $1,000. We can do some quick mental math. Yeah. That was not planned. But if we look at the blue line, which is the stock price, and then the red bars are going to be your negative options P&L, we see stock go up to something like $1,500 at expiration. So it's up 25% in 1 month, and it's up 50% the next month. So, talk about that right tail of distributions here. But even though, as stock first starts to climb up in that first week of July, call it, stock's going up and your options P&L hasn't quite materialized yet because you're still in the first half of this options life cycle. That options P&L doesn't really start to get negative until the clock starts ticking on you. That when you get that first stock spike, you're going to lose a little money on your options. And if you hedged, you might actually be pretty well hedged in that point, or from a P&L perspective. But when that move happens, if we had dipped right back down, the loser would have gone right away. And so like that time aspect here and where the stock moves and when it moves there just have a pretty significant impact on the results overall.
We can continue with I'm going to go to the next slide here because you're going to continue with the path dependency discussion.
Yep. So here we have the comparison of simply owning Tesla stock versus the portfolio, which would be trading every single month. So we're not yet using the indicators on this. This is the systematic monthly overwrite. And I think the paths really start breaking down pretty quickly along about 2023. Because while you can see the red line, the portfolio of covered calls trails the stock, it generally keeps up. But what you start having in 2023 is a couple big spikes that you take big losses on. And then because of our dynamic of buying that call in, you're really locking in that loss. It's the same as buying stock at that level. And so, you're setting you're taking negative cash out of you're taking cash out of your account to buy that call back, and that cash is gone. Because if stock goes back down, you're now holding the bag of maybe 2% premium to offset a big stock drop, and you got the carry forward losses. And so that kind of compounds against you over time as you see those choppy results. And this is the test that only goes through March, but we can see, as we all know what's happened in 2025 with the market so far, the first 3 months of the year, Tesla stock went straight down. And you've locked in all those gains all the way up, but they don't provide any padding on the way down. You're only collecting that 2% premium. And when stock gets cut in half, 3 months of 2% premium, that doesn't really, pad your downside.
I think there's
I
an
think it was 7% of options premium I have here that we collected.
right, and
So
I think just to reiterate again, it's just being repetitive because I know this stuff can be feel a little bit complicated sometimes, but the idea that the portfolio value, but the portfolio being the long stock, the covered call portfolio, long stock, short call, it's always trailing, and this in itself is not telling us necessarily anything negative, because it's good to point out that the right benchmark for I'm long a call and short a 25 delta call would be the right benchmark is I'm only long 75% as much stock. So you would always in a market that was constantly increasing, you would expect that the long stock position would outperform a covered call position. So just the fact that the red line is always below the blue line here is not necessarily an indictment of the covered call strategy in and of itself. I mean, as a matter of fact, this is why we're digging deeper, is because this is not enough to tell us if selling covered calls is a good or bad strategy. It's just so happened that this stock has went up 1,000%, and if you sell the covered call, that it's the equivalent of just being less long something that's went up a lot. And I think that's just to reiterate that point again here. Actually, come to think of it, this gets into an important topic, which is when we run this, we have to think about how to think about the sizing, because Tesla went up 1,000% in 6 years. If you think about it, in the beginning, when Tesla was a lower price, and you sold the call, if you just sell one call every month, selling one call after 6 years has passed, and after Tesla has grown over 1,000%, selling one call is far larger position than when you sold it in the very beginning. So actually, what we did is we normalized all the risk to as if Tesla was a $100 stock, so that we can keep the scaling on the call selling constant over time. So you're always taking the same amount of risk as far as how many calls you sold. Now, the volatility varies over the life of the option, and if you sell an option in a higher vol environment than a lower vol environment, yes, that's technically a more risky trade. We didn't normalize for the vol levels, but I think normalizing for the stock price level is a sensible thing to do, because generally speaking, people will kind of, even if it's not, say, on a quarterly basis, it's unlikely that somebody would watch Tesla go from being 10% of their portfolio to being 90% of their portfolio without doing anything about it in the meantime. So I think that even if scaling the position size to a constant $100, that might not be a perfect representation. You do have to make a choice, and I think that was a better choice than just assuming that we're going to let Tesla risk become the entire risk of our portfolio. So I think, and you can't really compare over time if you don't normalize, because what will happen is the later years will end up, whatever happens in the later years will dominate your entire time series if you don't normalize over time. Just the same way that if somebody's approaching retirement and if the stock market, if they just compound for 30 years, and then in the very last year before retirement, the stock market drops 50%, that 1 year is going to dominate their entire CAGR for the last 30 years. Where in reality, they probably took risk off the table as they approached retirement. So I think this is
I
just
think
like a
that's
sensible
exactly what you
choice.
see in that previous chart. Is that if you had kept your shares like that you purchased at the beginning and let the drop from January 1st, 2025 to March 2025, it wipes out, like in the covered call position, it wipes out like 80% of what you did over the prior 7 years because you were so axed to Tesla, over the last 3 months.
That's right. So that's just a word on which I think is just a helpful thing overall, just to remember that whenever you are doing studies, you do have to make these choices about trying to mimic how an investor would actually behave, um, and making sure that the way when you are doing a study, I want to make sure that I don't have these strange artifacts where like I'm just taking a lot more risk in some part of the chart, and then that is just going to dominate the entire result. It's very hard to like figure out what's going on if you're going to allow that to happen. So just a comment on creating studies. Um, this is so this okay. The next one here is what kind of is the idea of volatility P&L, this chart, and what were are this these words here. So one of the, like I said before, when you trade an option, you're always, the idea of trading an option is that you're always trading volatility. So if you sell a call, and if you sell a call, the question you really want to ask is, did I win? I don't want to know if I won because the stock went down, because I didn't need to sell a call to profit on a stock going down. I could have just shorted the stock. So the question of like, was an option the right tool for the job, doesn't get answered by just looking at the P&L of the call option that I just sold it, because I could have just got that directional bias from another way. To understand if the option expression of the trade was the right expression of the trade, I have to see, did I win or lose to the volatility that I sold? That's always the question. So to understand that, uh, well, let me go. What did I write here? Okay, so that's pretty much what this all of these words just say. So what we're doing is we want to find out basically if when I trade an option, am I being properly compensated for trading the option? That's always the question that we care about. So this gets into separating what is the volatility portion of the P&L from the directional P&L, and that's what we're going to talk about here. So to disentangle the options P&L due to its volatility, what we can do is we can simulate a position where we start delta neutral. So like we can sell a call and we can buy the stock, and we can I'll give an example using an at the money option. If I sell an at the money call, a 50 delta call, and if I sell one call and I buy 50 shares of stock, my initial delta is 0. That means that I have no directional exposure to the stock. And that's because if the stock goes up $1, my call will lose money. It'll lose money on a 50% sensitivity. So if the stock goes up $1, my call will lose 50 cents. However, remember, I'm hedged by being long 50 shares of stock. So I'll make 50 cents on 50 shares of stock going up $1. So I'm neutralized to any directional aspect or any directional move in the stock with this delta neutral position. However, in this scenario, let's say the stock goes up $1. My 50 delta call that I'm short has actually increased a little bit. It is now, say, let's just say it's a 60 delta call now. So, and I'm only long 50 shares of stock. So what happens, I'm actually now slightly short the market at the end of that day because I'm short a 60 delta call, but I'm only long 50 shares of stock. To rebalance back to delta neutral, I need to buy 10 shares of stock. So now I'll be long 60 shares of stock and I'll be short a 60 delta call. I am now, once again, I'm neutral. One thing I will just point out is that in the process of rebalancing back to delta neutral, when you are short options, you are always buying high and selling low. Because notice what happened here. The stock went up $1 and I had to buy 10 shares. If the stock were to drop $1 again to go back to being a 50 delta option instead of a 60 delta option, well, the stock drops. I am now short a 50 delta call and I'm long 60 shares of stock, remember. So I need to rebalance back to delta neutral. So I need to sell 10 shares of stock. So I'm going to sell 10 shares of stock after the stock drops $1. So what I've actually done is I've locked in a $1 loss. I've bought the stock up $1 and I've sold it down $1 on 10 shares. So I've locked in a loss. That's the cost of your theta. When you sell an option, yes, the option does decay over time, but when you delta hedge it, you are incurring losses on every rebalance that you do to go back to neutral. The essence of options trading is, did the sum of all my negative, we'll call it scalping, that buying high, selling low, did the sum of all my negative scalping, is it more than or less than the theta? That is the entire idea of realized volatility, the realized volatility portion of your P&L. It's a tug of war between how much does the stock move and how much do I lock in realized losses on rebalancing versus how much the option decays, the theta, over time. That is the realized volatility portion of your P&L. There's one other portion of your P&L, which is the implied volatility portion. And that's the idea that if the vol was 30 on that strike and it goes to 32, you are going to have a mark-to-market loss because you are short and the option's value increased and you are short that option. Likewise, if the vol went from 30 to 28, you would have had to mark a mark-to-market gain as the vol declined, right? So you have two volatility aspects of your P&L. The realized portion, which is this rebalance theta tug of war, versus the changes in the implied vol. Why do we do this? And it's to reiterate, because we're trying to understand how much of our profit and loss is coming from the volatility aspect of trading the option. I kind of wrote here, I'll just say it, but if the concept sounds familiar, it's because it is. This is exactly what we do when a relative value investor neutralizes the beta portion of their portfolio. They are trying to decide, is the fact that I'm actively picking stocks adding or subtracting value? Are my decisions to trade these individual stocks adding or subtracting value relative to a benchmark? Right. So by doing a delta neutral position, what we're doing is we're essentially neutralizing the beta. It's what regular investors would call neutralizing the beta, and then what's left over is just their profits due to their active choices. So this is like the whole idea of separating skill from luck. And what we're trying to do is understand, are we doing a good job of choosing options? And that's why we separate these P&Ls. And we see it here, kind of the algebra of it, which is just your vol P&L is what I described earlier. It's your implied change in the implied vol of the option. That's your Vega P&L versus that tug of war, the realized P&L, which is the gamma, all those gamma scalps or all those scalps, that's your gamma P&L. And then your theta P&L is how much the option decays. So, did the option decay more than you lost in your gamma P&L? If it did, then you would have a positive realized P&L. And let's say the vol was unchanged, in that case, you would have had a positive P&L if the stock didn't move enough to overcome the theta that you were collecting. All right, so this is how we decompose an options P&L. And this tells us, when I sold the option, regardless of the direction, did I do better by choosing to trade that option or not? So that's why we do this decomposition. this kind of goes into the exact, and we can share this later. This just goes into the exact calculations how we did it, but I don't think we need to dwell on that right now.
But I think I want to emphasize one of the things that you said earlier about like the idea that delta is a sensitivity, and that because it's a sensitivity that's coming out of the pricing model, and the options pricing model is basically a replication model of it, and when you're analyzing the price of this option and how it's priced, you're asking, is it well priced? Is selling this always, is this an expensive option or is this a cheap option? And by looking at the way that you would hedge out, in this case theoretically, but practically plenty of people do this when they're trading options too, is if I use my model to determine these sensitivities, whether it's my current delta level for my hedge or whatnot, is this option going to produce net returns vis-a-vis this model? How accurately am I truly pricing this? Because at the end of the day, like, yeah, your delta and your theta, they're just sensitivities that are coming out of the pricing model that you're jamming all these implied volatility numbers into.
That's right. What we're going to do here actually is we're going to look. So just to recap a little bit, we saw that by just naively selling, the 30-day call, the covered call in Tesla, we doubled our money over 6 years versus making 12x on our money over 6 years if we just bought the stock. Now, had we elected to not sell covered calls, but instead choose to be long only 75 shares of Tesla stock, 75% of the Tesla stock, we would have done better than selling the covered calls there too, right? Because let's say we made 10x on our Tesla shares, we would have made 7.5x had we only had a 75% position. So it feels like, compared to the alternative of just owning less Tesla, selling covered calls turned out to be a very expensive decision. And again, I don't think that that's a shocking realization when you say, I'm going to cut off the right tail of returns and the stock went up 1,000%, to have discovered that. Now, Mark, before we go into looking at the delta hedge strategy, did we want to talk about what the performance of the covered call strategy was based on the indicators?
Yes. Let me pull up that. So, with one of the things that's interesting about the indicators is I'll say in almost all cases, using some indicator was better than no indicator. That having some sort of filter on the trade improved the results marginally. And the degree to which that improved it ranged from barely at all to actually producing net positive results in 2 cases. So, that's the kind of spectrum of results that we can see. I think what I will say, to put, to lead with the, or to not bury the lead, is while indicators might improve the results, I didn't feel like there was a significant like aha about any of these indicators. That, we're looking at a relatively naive style of indicator, just looking at the 50th percentile. We're not contextualizing that other than, relatively. So, there are definitely ways you could improve on these and different combinations. But at first blush, these basic vol indicators only really marginally improve the results. And a big way they improve them seems to be that they reduce trades. Ironically, some of the ones that did the best, out of 70 total trades during this test period, the one that actually made money only traded 3 times or 9 times. So it's hard to say that trading, less than 10% of your opportunities is really enacting a covered call strategy. That indicator might be interesting for a different way to trade Tesla. But as far as a signal for a covered call strategy, I think you'd be hard pressed to say you're trading covered calls if you make 3 trades in 7 years for someone.
I think what's interesting is that the indicators act as a filter that say, rather than just do the naive strategy every month, Let's check for this condition. If true, then do the strategy. And uh, it seems that the reason that they won is because you just didn't do the strategy every month. And that was the best. Like that was the best thing to do, was basically just not do that strategy. So anything that kept you from doing the strategy was going to be value added, which is, um, which I think is interesting to point out. It's also, it means that like it's a bit underpowered to even be able. It's hard to say anything about like the specific value of the strategy. Then, like, did this thing, other than the fact that we can look at like the relative performance of the different. Like, yes, they all made the strategy a little better, but some of them made them a lot better. But it seems like it was just the correlation there was just the less you traded, the better you did, and any strategy that was the most restrictive strategies were just going to be the best just based on that alone.
Yep. And if I were to like rank the indicators, I would say from least performing, VRP was the least indicative. That looking at historical risk premium in the vol market was not necessarily a forward looking indicator for risk premium, because essentially that's what you're looking for. If you're selling a call, you're looking for implieds to be higher than what they realize. Not a great backward, looking at how that's been either on a 30-day or 1 year basis isn't necessarily predictive. IV was moderately predictive, maybe marginally better at the 30-day than at the 1 year, but neither were particularly brilliant. And then I'd say skew in the short term was probably, if there was a winner, that would be the most powerful signal through a lot of that noise. That, and I can kind of grok that on a intuitive basis that short term skew call bid might be a good indication of overpriced, opportunities to sell. That narrative sort of makes sense to me. I could also, convince myself of the opposite. So that's why you got to look at the data.
Yeah, and I think it's worth mentioning, like, just how you could narrow. I feel like a lot of what I try to do when I'm looking at a change in an option surface to sort of narrate what the market might be thinking to create some context. And that's interesting when the calls get very bid in Tesla. What's interesting about that is you could interpret that as flat out bullish, in which case it's not totally shocking to me that a covered call strategy into a call skew bid would be good, because your fundamental position is still long delta. And the idea there is just people are probably just overpaying for the calls. Like, that's where the risk premium is, versus like a typical market where the calls are sagging because they tend to be sold. Actually, when they start coming for them, there is now the risk premium thinking flips, and now you are harvesting a risk premium by selling into the bid, while maintaining the fundamental position that the market is bullish because you're long delta. I think, however, like you said, you could narrate the other side to that, which is like the stock replacement side, which is saying that they're coming for the calls because they don't want the hard delta, because they're saying, I want to own. It's like GME might be a better example of this. It's like the right way to maybe have traded GME for these people is to say, I don't necessarily want to own the stock, but I know that the stock can kind of just like the final value of this stock is probably not higher, but there's a path where this thing rips way higher, and that is telling you something about the value of the call versus the stock. It's telling you something about the distribution. So if you think something has like a massive positive skew, but it's probably still going to go to zero or still going to go down, owning the calls is the right trade, not buying the stock. And I think that, and that's something that we see that in lots of markets, that kind of like, you tend to see that in commodity markets where there's like a short squeeze. It's like the calls get bid and the market is right to bid the calls, and versus sort of like all that expression of that trade going into the outright spot price, the delta itself. So I think you could sort of narrate a call bid in Tesla two ways. Is it's kind of bearish. It could be kind of bearish where people are like, I actually don't think the stock's going up, but I think it has this long right tail. or it could be bullish. And I think that that's, at the end of the day, this sort of highlights the difficulty always with options is sort of like trying to triangulate what the market's saying. And in my opinion, makes anything that just constantly systematic about things really, really difficult to do because um, options prices can change they can change in the same direction for different reasons.
Right. And if we think about the fact that the skew actually net made money on that trade, it was probably points to the stock replacement theory a little bit more, I think, because that means that you're not going to make a bunch more money like selling that much higher premium. It's not necessarily coming back. It's probably avoiding the big losses
Yeah.
that come from the delta actually ripping.
Right. Yeah, it's like this stock's super volatile. I'd rather just own the calls than own the stock.
Right.
And conditional on that being true, the stock's probably going lower.
Exactly.
Yeah. Let's go. So, were there any other? I think the other thing you did was you also combined some indicators where you looked at what happens if I filtered for multiple indicators triggering at the same time. So very, very, very restrictive filters.
So if we went to the maximally restrictive filters of like 75th percentile, like all indicators passed, you literally made one trade in the entire time. So there's only 1 in 70 scenarios where you saw like a very high reading on all of those, and you won on that trade, for whatever that's worth. But as you combine them together, honestly, skew only seemed like the best combination. IV, VRP, not that leading. Skew and VRP again combined didn't really generate much. Like really, again, it comes back to being restrictive on these trades and which scenarios, and it gets back to that path dependence, right? Like a lot of the returns that accumulated to the stock came from some of these huge rips and conversely the big losses on the option side too. So to whatever extent you could avoid those when they happened, however your signal happened, that was almost a stronger element to this than saying, hey, I found something that indicates mispricing truly in this option. That like it's not necessarily, these are vol indicators trying to assess a vol mispricing when directional big moves are what really drove a lot of the returns on both positive and negative side.
All right. So let's then bridge that from the indicators on the overriding strategy, on the covered call selling strategy, to let's now look at the results. We'll skip ahead now here to look at the results of the delta neutral strategy. So basically, let's rebalance a delta neutral position every day. We're no longer investors selling covered calls. We are vol traders trying to isolate the volatility. So we're going to go to the cumulative. We'll start with the basic thing, the cumulative delta hedge strategy. So what's the strategy? You sell a 25 delta call each month, and this is the same 25 delta call that you sell we're choosing the same call that we sold in the covered call strategy, except for this time, instead of having it as a covered call position, we are to fully hedge the delta. So we're saying I sold the 25 delta call and I bought 25 deltas worth of the underlying stock. And remember, we normalized everything to $100. So even though Tesla went up 10x over the study period, that just means that at the end of the study, we're trading at 1/10 the size as we were at the beginning of the study. That way, our performance over time is you're able to compare performance over time. So what we find here is that by fully delta hedging the option every day, the idea is we are trying to isolate the vol P&L. We're simulating that. So what happened? So it turns out that, again, normalized to $100 stock, your cumulative P&L on a delta hedged Tesla position, it was $3 over the 6 years. Like 50 bips a year is how much you made selling a 25 delta call every month and delta hedging it. That is the assumptions here is, first of all, there's no costs assumed in the delta hedging. So this assumes no daily trading costs on your delta hedges. However, it does make an allowance for, it assumes that you sold the call on the bid. So it assumes a reasonable guess for the option slippage. It assumes no slippage on trading the stock, which is, if you traded market on close every day, you are not really getting any slippage to the prices that we're using. We are ignoring the direct transaction costs for trading stock, but you are you can get the closing price every day with a market on close order.
And I would even say, like a professional level, VWAPs are getting close enough that they can get pretty close to the fair price.
Right.
That, like, if you're really dynamically delta hedging, you're probably getting pretty close to fair on the hedge.
I think that's fair, for sure. At the sort of professional vol trader level, you're talking about daily slippage and basis points that is probably under 3 bips. So, but what's interesting here is you make 50 bips a year on trading delta hedged on these calls. Now, what is the driver of that P&L? So it's mostly realized vol P&L. This makes sense because if you're trading a 30-day option, you delta hedge it every day. On average, your average duration of your trade is that you have a 15-day option on over time. And a 15-day option is almost entirely dominated between that tug of war between realized volatility and theta. It's the Vega portion of that P&L is not that significant versus if you were trading a 1-year option, in which case the realized vol is a very small contributor to the option P&L, and it's almost all coming from implied vol changes. So the realized portion of the P&L is you lose $60 on a $100 stock over on the realized, and you lost 20 on the Vega. So on average, by selling the options, you actually did lose on the Vega P&L on these calls. Now we get this, you're like, wow, shouldn't I have lost a ton of money? Well, the thing is, when you do an attribution, there's this concept of a residual or unexplained P&L, what's left over. The reason there is an unexplained P&L is because Greeks are they are sensitivities, but the Greeks themselves have sensitivities. There's first order Greeks, second order Greeks. So what's happening, you can think of it this way. Let's say I sell, let's just go back to the idea of selling an at the money call. Let's say I sell an at the money call and I buy the stock. So I'm short gamma. If the stock makes a really large move up, the way that we're saying what our gamma P&L is, we're saying what was my gamma like last night at the close on my delta hedged position, and then I'm computing the gamma P&L from then until the next day's close. Except for that is going to overestimate the negative gamma P&L if you have a big move, because your gamma was not constant over the entire size of the move. If the stock went from $50 to $70 in one day, you would have almost no short gamma anymore by the time the stock was probably crossing 60, 62, 63. Like, you don't even have gamma at that point anymore. Like, your short call is basically 100 delta. If your call is a 100 delta, by definition, its delta is not changing anymore. So there's no gamma. So your gamma P&L estimate will overestimate the negative P&L. So what will happen is your actual P&L, and that's how we're doing this, is we compute an actual P&L every day, which is just simple accounting. It's just what's my stock position times the amount that the stock changed by, and then what's my option position times the amount that the option mark changed by. the attribution is the theoretical portion of like, hey, where did that change in the option price come from? And that's what we're allocating to Vega and realized vol P&Ls. But what'll typically happen if you're short an option, you have a large move away from the strike, you are going to have a positive unexplained P&L that offsets that giant loss estimate that you have. And that's because your gamma is less as the stock moved away from the strike. The same thing can happen with Vega. If I'm short a lot of vol and vol rips higher, but the stock moves away from the strike, the Vega of your position will likely decline because you're moving far away from the strike. So it's gonna look like, wow, I'm short 1,000 Vega and vol went up 20 points. I'm gonna lose $20,000. But your average Vega over that distance of the move was not really short 1,000 Vega, because you moved by the end of the move. You might not even have any Vega anymore. So your average Vega is going to be something less than 1,000. So that's going to be an overestimate. So when you look at your actual P&L, it will not be as bad as what you predicted. So the difference between what you predicted and what actually happened is the unexplained or residual P&L. So in this case, what we find is that your realized P&L and your Vega P&L are quite negative, but then your unexplained P&L is positive. And as we're going to see later, that unexplained P&L comes from less than 1% of the days. 60% of this unexplained P&L comes from less than 1% of the days. As you can imagine, it's the days when you either moved a lot so that the prediction was not going to be very accurate, or that you're very close to expiration, in which case your Greeks, if you move far away from the strike, your Greeks are going to go away really, really quickly. Or if let's say you're short an out of the money option and all of a sudden the stock moves towards the strike and your option picks up a bunch of Greeks, in that case, your prediction is going to be bad because you actually had more Greeks than what you thought you had. So what will happen is, as you get close to expiration or on really large moves, those are the two scenarios where you tend to see a very large unexplained P&L, either positive or negative, depending on if you move towards or away from your strike. So okay, that was a big detour, but like it's a bit of a more advanced concept. But the point was to see that if you had delta hedged the 25 delta call every month, you made $3 on a $100 stock over 6 years, or 50 bips a year.
I think it's important to note both like the magnitude of that 50 bips, that like that to me says options are very well priced here in
Right.
general. That like, hedging these out, like, trying to isolate just that volatility component of the P&L, really shows just how efficient these markets are. And even further looking at this strategy, I can see the evolution of that hedging strategy over time. You can see that they are getting more efficient in some ways. That I see a lot of that P&L being generated in 2020 and then flatlining for the rest of the time, if not giving back some. So that as Tesla's gotten to be a bigger name, as it got added to the S&P 500, as it just became more liquid, in general, that's going to produce less and less, vol risk premium or, the positive hedged P&L out of that strategy.
Yeah, I think that's a great point, and just like little, not, I wouldn't call it inside baseball, but like one thing to understand is uh these very large liquid names that have a lot of options volume and interest. I mean, the market making in them is every major market making firm has a large presence in these names. The top ones, and especially the fastest ones. I mean, one of the ways you can be guaranteed to lose money is to think that you're going to be a market maker in a super liquid name, because you're just going to get picked off all the time on delta. So it tends to be the playground for really the top market making firms are the ones that are going to sort of dominate the market making in a very fast liquid name. And I don't think it should be surprising that they do a pretty darn good job of pricing the options in something that is very liquid. So this is just the time series, and as Mark pointed out, the key feature here is that this strategy spends a lot. The cumulative P&L spends a lot of time sort of going sideways after 2021, and you kind of see it dip. It kind of falls apart here towards late 24 up to coming into March of 25. Actually, this is mislabeled here. This is going to D's 24, but it's actually going to March. We originally did it to D's 24, and then we extended the work to the March expiry. So I think Mark kind of hit the important part of that chart. Then what we're going to do is say, hey, let's look at these delta hedge strategies using the indicators, so the filters. So here is what we get if we looked at the VRP. When the VRP, this is using a 1 year look back, and if the VRP is greater than the 50th percentile, we are going to say, then we're going to trade. We're going to try to trade this straddled, or we're going to try to trade these 25 delta calls delta neutral, rebalance every day. And here we get a hedged P&L of $9 over the past six years. So you're making a percent. Now you're making 1.5% over 6 years, or annualized from this strategy. And you can see though that the bulk of this return as well is coming from up until sort of like mid to late 2021, and then the strategies, the profit sort of slows down quite a bit. You do see also these flat lines here. You get these flat line, these sections where the line just goes flat. That's where where the signal would not have triggered. You would not have a trade. So that meant like at that expiry, you did not sell the call delta neutral because it was not higher than the 50th percentile. So you're starting to see you start to see the effect of like not having any trades here, which is that you're getting a smaller sample size overall. So you have a lot of periods here. I guess if it's random, you would expect half the periods to not trade.
And it's right around there. It's 32 out of 70 trades
There you go. So
for this instance.
I'm glad that you have the statistics up in front of you. I don't have them. Okay, so that's the if the signal is the VRP is high, the delta hedge signal. Here is same thing, but instead of using the 1 year look back, we look at this is the 30-day look back, and you can see it's basically a push. You're losing $1 over 6 years. This seems to be the 30-day look back. In this case, looks like you just get a fair. The options seem to have been well priced on a delta neutral basis. There's no signal there. Okay, so this is now, instead of VRP, we look at the implied vol greater than the 50th percentile. This is a 1 year look back, and we see again we get these stretches where you do no trades. So that would actually make sense in these cases where you have a 1 year look back and then you go into a regime where vol is high or low, and it still has that 1 year memory. So if vol were to, in this case, it looks like what happened is like vol reset lower. And so your implied vol never got as high, or wasn't really triggering as high as it was, say, 7 or 8 months ago. And here you're doing less trades, and your hedged P&L is losing $2 over 6 years. So again,
It's always a balance with indicators, right? Like, is the reflexivity of the short term, or reactivity, I should say, of the short term versus the like long memory of a 1 year indicator, and there are pros and cons.
yeah, I think that's a great point. And just as an aside to that, it's like we are looking at we're talking about trade quantities here on the order of one a month for 6 years, not even one a month because they're being filtered. So you're talking about like less than 70 trades. This is very small sample size, and you can see just how noisy delta hedged P&L actually looks. I mean, it is, the error bars around this stuff are really wide, which I think if you had to pull a lesson from that, it's, uh, you know, back testing a delta hedge strategy for 1 month trades, I just don't even know if you're on solid ground trying to draw any confident conclusions from any kind of work that looks like that. So it's just your just sample sizes are just far too small.
I think some of that shows in like the unexplained aspect of it too, right? That like, especially if you're only hedging day over day, with the moves that this can make on a day over day basis, right? Like your difference in price can be enormous from close to close.
I,
And like that strategy of not only trading fewer times, but only trading once a day is gonna have an impact on the results of a delta hedging, strategy.
Yeah, I think if you want to, you can think about this a bit more abstractly for the people that are more inclined to think about option in option theory terms. But the sensitivities of an option, they're defined. So like theta is how much is the option decay for 1 day. That's the definition. Or delta is how much does this options price change for a $1 change in the stock price. So these are definitions. When you have a day, so when we do our attribution, we're taking this Greek that has sort of a unit attached to it. And we're saying, okay, what was my performance of this Greek over 1 day? But if your 1 day move is multiple standard deviations, another way to reframe that would be we had multiple days move in 1 day. So when I go and I look at my Greeks from yesterday, I'm saying, what is my Greeks on a 1 day basis? But I just had a multiple day sized move. So
Yeah.
it's not surprising that your Greek starts to be a poor estimate of what happened because your Greek was defined in units of 1 day or $1, and you just had these moves that are like almost of a different unit. So we don't have a concept of Greek per hour, right? If you had that, then you could run all of this on a Greeks per hour basis. And then if you kept getting smaller and smaller slices, Greeks per minute, you would actually find that your unexplained P&Ls would just shrink because you would be able to explain everything in terms of these Greeks and their units. It's a little bit of, I think it's probably a little bit of abstract, and I probably lost all but one listener, but it does get to anybody that's interested in that concept of P&L attribution is probably something they've thought about before. Sorry, this was again, it's not super interesting what we're seeing on the chart here. Hedged P&L losing $1 over the 6 years. And this is if the IV is over the 50th percentile using just a 30-day look back. This is the skew in the 50th, greater than the 50th percentile. Remember, this was sort of our best signal on the covered call study. And you find here on the 1 year look back, same thing. You have that stretch once again where you're not doing any trades, but you're getting, again, it's basically a push. Your skew greater than 50th percentile is not generating any, didn't seem to generate any great hedged P&L. And then,
which to me says that on thinking about it just from a covered call basis, as opposed to a delta hedged P&L basis, that skew indicator let you avoid the big rips up, I think.
yeah,
That by stepping out of half the trades in that scenario, helped generate positive or not lose money in the overwrite scenario, but but it wasn't explanatory from a pure vol pricing standpoint.
I think it's such a great point. It's basically like that right. That difference right there is a great indicator of like the vol is actually pretty well priced. And what was happening there was just the directional aspect of getting out of the way when the skew was high was a good signal, which is leads to this question of like this fertile ground for option metrics, not necessarily because you want to trade vol, but option metrics as inputs into directional triggers. So, if the call skew is high or low, is that an interesting signal that goes into your delta trading to somebody that trades delta one? So I think that's a whole universe of potential research for people that are more Delta One trading, where they're taking, hey, I care about vol metrics. I want to know what's happening in the vol market because maybe I can figure out directional trades based upon what option services are telling me. And then maybe that's better than trying to figure out how to trade vol off of what the option service is telling me. So here we have this was the best indicator on the covered call, and we get some confirmation here because this one worked the best out of all of our delta hedge strategies, which is when the skew is in greater than the 50th percentile, using only a 30-day look back, and we find that this is actually pretty steady and has continued to work. So a delta hedged so this is interesting to me because we were conjecturing before, how much of that signal might have been that coming from the fact, like the stock replacement idea versus the call skew getting bid because the market was bullish. And this is just this feels to me like it says, actually, there's just a vol premium that goes into these, because if I delta hedge this trade, I'm winning to it. So insofar as we can make a statement, maybe that's the statement that we could say. I'm pretty hesitant about saying anything with confidence, to be honest.
Yeah, totally agreed for all those sample size points and just the frequency of this trade. I think it more illuminates elements of the strategy than prescribes a specific strategy.
Right. And then, okay, so one thing we did here, so remember our study ended in March. So this is convenient, but a week or two ago, we launched the attribution tool in the Moontower app. And so what I was able to do is say, hey, what would have happened had we sold the 1 month call after the March expiry? So now we can look at the April expiry. So just a little background. On March 24th, which is the day after March expiry, that Monday, Tesla was at 278.5. The 320 call, the April 320 call, was 24 delta. So that was the call we select here. It's closest to 25 delta. It was $6.15 or 2.2% of the spot price. Now, the attribution, the way our tool works is it shows you what the P&L attribution is, assuming from the buyer's point of view, had you bought this call and delta hedged it. So if you had bought this call and delta hedged it, your final P&L is you would have made $4.55 on this call. So, which is enormous considering the call was $6.15. If you had delta hedged it, you made $4.55. Now, this call expired. Now, interesting to note here, this call expired worthless, right? So, because that 320 call was worthless at April expiry. So, if your unhedged P&L is that you would have lost the entire premium, the $6.14 or $6.15. You just would have lost your premium. Had you delta hedged this call, you would have made $4.55. And the reason is on April 4th, Tesla dropped 11% in one day. When you bought these calls, they were priced, the vol was in the mid 60s, call it 65%. The P&L eventually these calls are so far out of the money that they no longer have any Greeks. So you see this sort of like on the last few days before expiry, like there's no attribution really anymore. And that's just because there's no more Greeks to this option. It's just a zero delta. But when it still had some optionality left in it, the vol was 100. So you bought some option here that went from the mid 60s in vol up to 100% IV. And if you had delta hedged it, you crushed it. I mean, again, when you buy an option at 65 vol and you have an 11% move, remember, like rule of 16, that's equivalent to 176% vol move in one day. So if you buy vol in the mid 60s and you have a 176 vol move in one day, you're going to make a lot of money that day. So that was sort of the best day. And so likewise, flip this over. If you are the seller of this call on a delta neutral basis, then you get the negative of this, the negative final P&L. So you pretty much get rinsed on being short these calls after the April calls. What happened the next month? So we have until May expiry. So if we look at the May expiry, This is when Tesla was near its bottom, right? Like $227 on April 21st. The 270 call, the $23 call was about $5.80. Big premium as a percent of spot, 2.56%, because the vol was high. The vol was about 79%. You would have sold the 270 call. Tesla went to 350 it went up 50% to 350 by May expiry. The calls that you would have sold expire $80 in the money. Here's the crazy thing. If you had sold these calls in hedge daily, you won. Because remember, this is from the buyer's point of view. You would have won $3.17 if you had sold these calls and hedged them daily, which sounds crazy because the stock was up 50%. But remember, goes back to assumptions. The assumption here was that you hedged daily. And if we look at the daily returns and we look at the daily attribution of the P&L, Tesla on April 25th, the only bad day you have, really bad day that you have from a short point of view, is that Tesla went up 9.5% in one day on April 25th. The implied vol actually got hammered on that day. So you actually did not really get hurt on your implied vol, but it was just the realized vol. But you had sold vol at 79% instead of in the mid 60s. So even then, your P&L, even though it's a loss, it's not catastrophic, but you only lost on 2 days being short this option. Now, on May 12th, Tesla goes up 6.5%. That's another losing day, but you win every other day pretty much of this expiry cycle. I guess there's these would have been like small, like tiny losses in here, but for the most part, you're just winning the entire month on being short these calls, even though the stock marches up 50% over the expiry cycle. And I'll point out one other thing. Had you hedged weekly instead of daily, in that case, you would have lost to this, because what's happening here by hedging daily, you only really have to suffer one really giant move. But if the stock goes up 50% in 4 weeks, that's a 10% move per week on average, more than a 10% move per week on average. So if you only hedged weekly, you were basically suffering 10% losses every week on your delta hedge. So this just kind of goes back to assumptions. But anyway, I thought it was kind of interesting. In this case, this option expires way in the money, and being short at delta neutral, you were actually winning. Again, this tool here exists in our Moontower app, just to plug that. But
Totally. Well, Kris, I hate to interrupt you here, but I'm going to have to let you take the conclusion because I have
yep,
to. Unfortunately, I overbooked on this. But this was a super fun study. I think I'll let you take the full conclusion, but what we dug into here, I think, just illuminates so much about the overall strategy and how to think about what the options markets are telling us, even with this just basic overwrite. So I had a blast doing this.
totally. And I just want to give Mark a big shout out, because he was the one who gathered all the data, which is, we've been actually working on this for 6 months, sort of like asynchronously, and whenever we can fit it in between life. And I'm really glad we were able to get this out. And we kind of didn't do it as a write up, and we did it as slides, because I think we just kind of ran out of energy at the end here, and we're just like, you know what, we could just talk through this and capture everything we want to say. So, but anyway, I want
As you
to.
can see, we had 90 minutes of content easily to talk about.
Yeah, I think this would have been a small book had we written it up, and just no interest in doing that.
Next time.
Yeah, but all right, Mark, I'll let you get going. I'll wrap up here, and yeah, just thanks again for. I mean, I felt like you really were the one who supercharged the getting this going. Thank you.
No, this was great. We had a ton of good insights here, Kris.
Yeah,
So thank
awesome.
you. Cheers. We'll talk soon.
All right, later. So I'll just wrap it up here. Just this is sort of an extra thing just on this. I kind of talked about this already on your unexplained P&L, but this is just a scatter plot of what your unexplained P&L charted against move sizes. And you can kind of see on these, so a lot of it was on these positive move sizes, positive moves. Remember, you're short these calls. So this is like going up towards the strike, and your unexplained P&Ls were sort of larger. But in general, the largest ones happen, well, this is kind of this outlier here, but it's on these large moves. But there's some some small, the curvature here on a large move, you get more unexplained P&Ls. You can kind of see that effect there. And then this was just highlighting the fact, I kind of described this already, the bias in the unexplained P&L being positive or negative based upon whether you're going towards or away from the strike. But the main thing is they tend to happen on large moves, and they tend to, or when your DTE, when you're close to expiry. And we can kind of see that. This is me grabbing all the cases. Actually, what's interesting is the number of 3 standard deviation residuals, 3 standard deviations or greater residuals. This is basically exactly what the normal distribution would have predicted, although the size of them are not. This is a 14 standard deviation move, which is clearly not part of a normal distribution, but the quantity that was greater than 3 standard deviations, this was sort of like all the large moves, and actually did conform to how many you would have expected based on our sample size. And you can see that almost all the super large moves and the super large residuals happen on large moves or low DTE. The other thing I noticed is that most of them happened in 2020. So just another observation there. And I titled this, "We shall not name the higher order Greeks that lurk below," but they are things like Vanna and Volga. It's basically, how does my Vega change as vol changes? How does my my Vanna? How does my Vega change as the stock goes to a different price? My Vega also changes, and that's the idea of one of the aspects of Vanna. But generally speaking, when you do an attribution, the those higher order Greeks, they tend to be a much smaller number than the Greeks that we do tend to measure. So it's actually not so bad at all to just kind of ignore them and just lump them all as a residual. Conclusions, or when you should sell a covered call. I think this was all sort of covered in here, but for the most part, I think that we discovered that the options market is actually fairly smart, especially in a very liquid name. I think the one thing that I kind of take away from it is, it is my bias, but it doesn't make sense to me to sell a covered call necessarily on a name where you own it because you think it has this long possible right tail. And Tesla, during its massive growth phase, I don't know what to say about Tesla today. It's an S&P component now. It's a lot more mature. Is the proposition of selling a covered call in it better today than many years ago when it was growing really fast? And I guess even if you think about Elon's pay package, like it was like a big call option. He took a giant bet on himself, which led to him becoming the richest person in the world. If Tesla had went up a whole lot, there's some part of that feels like, I don't know, selling a covered call against a stock that where this guy is like wants to load so much of his compensation on the possibility of the stock going up 10x. Just, I don't know. It just doesn't seem like a reason to own a single stock and then cut off the right tail. But from a vol perspective, we kind of saw the vol does seem to be pretty well priced in this. It's pretty hard to trade it delta neutral and think that you're getting paid enough to do that. And I overall hope that this was both useful from the theoretical point of view, understanding how to think about volatility P&L as the reason that you're trading an option in the first place. Separating it from the directional P&L, just like we separate beta from alpha in traditional investing, and then and just the actual results of what happened if you sold a covered call in Tesla. So again, thanks everybody. This entire thing will be put up on YouTube. So if anybody wants to check it out later or pass it around or whatever, appreciate the time. Thank you, everybody.